Summary of Chapter 1. Investment versus Speculation. A simple guide. When I first read Benjamin Graham's The Intelligent Investor, I was struck by how clearly he separates real investing from reckless gambling. In this opening chapter, Graham makes one thing crystal clear. Most people who think they're investors are actually speculators, and that's why they lose money. What's the difference between investing and speculating? Graham defines an investment operation as one that, 1. Is based on thorough analysis. You understand the business, its financial health, and its long-term prospects. 2. Promises safety of principle. You don't risk losing your money on a whim. 3. Offers a reasonable return. You're not chasing wild, unrealistic profits. If what you're doing doesn't meet these 3 criteria, Graham says you're not investing. You're speculating. Why most people get it wrong. I've seen this firsthand. People buy stocks because they're going up, not because they've studied the company. They trade based on tips, headlines, or hype, not fundamentals. Graham calls this the speculative component of the market, and it's dangerous because prices can collapse overnight. Think dot-com bust, 2008 crash, or meme stock crashes. Emotions take over. Fear and greed lead to terrible decisions. The market doesn't reward luck forever. Eventually, reality catches up. The defensive investor's strategy, for people like me who don't want stress. Since I'm not a full-time stock analyst, Graham suggests a simple, low-maintenance approach. 1. Split my money between stocks and bonds. A classic 50-50 or 60-40 mix reduces risk. 2. Buy stable, well-established companies, no flashy growth stocks or trendy picks. 3. Ignore short-term market noise, no panic selling when stocks drop, no FOMO buying when they surge. This strategy won't make me rich overnight, but it protects me from big losses, which is more important than chasing hot stocks. The aggressive investor's path, for those willing to work harder. If I wanted to try beating the market, Graham says I'd need to study financial statements deeply, not just glance at stock charts. Hunt for undervalued stocks, businesses trading below their true worth. Be patient and disciplined. Most people fail because they can't handle volatility. But here's the catch. Even professionals struggle with this. Graham warns that unless I'm willing to put in serious effort, I'm better off sticking with the defensive approach. The biggest risk? Myself. The most eye-opening lesson for me was this. The market isn't the problem. My own psychology is. When stocks soar, I'll feel tempted to buy more. When they crash, I'll want to sell everything. But Graham says that's exactly how people lose money. The antidote? Stick to a plan, like the 50-50 rule. Don't follow the crowd. Just because everyone's buying Bitcoin or AI stocks doesn't mean I should. Focus on value, not price movements. A stock isn't good just because it's rising. Final thought. Investing is about survival, not glory. Graham's message isn't sexy, but it's true. The goal isn't to get rich quick. It's to avoid going broke. By distinguishing between investing and speculation, I can make smarter decisions, sleep better at night, and grow my wealth steadily over time. As he famously wrote, open quote, "The investor's chief problem and even his worst enemy is likely to be himself," close quote. And after reading this chapter, I couldn't agree more.